Let us see the next question. Electraspace is a consumer electronics wholesaler. The business of the firm is highly seasonal in the nature. In 6 months of the year, firm has huge cash deposits and especially near Christmas time. The other 6 months, the firm cash crunch, leading to the borrowing of the money to cover up its exposure for the running business. So during like a period of the 6 months, so there is huge cash balances that we have, and for the other 6 months, so we are having like peak season and off season. We are having a scarcity of the funds, cash crunch. It is expected that the firm shall borrow a sum of euro 15 million for the entire period of the slack season in about 3 months. A bank has given the following quotations. Spot rate means the rate of interest for borrowing or lending right now. 3 into 6 forward rate agreement. It means that the rate of interest after 3 months for 3 months, after 3 months for 6 months. 3 months 50,000 futures contract maturing in a period of the 3 months is quoted at 94.15. That is rate of interest as 5.85%. So it is 100 minus 94.15. You are required to determine one, how FRA forward rate agreement shall be useful if the actual interest rate after 6 months turns out to be 4.5% and 6.5%. Then B part of the question is given to us that we will read later on. Everybody is requested to go through the question, please. Friends, over here it is 3 months, not 6 months. Please incorporate that change. Friends, over here the question is providing the information that we are considering two alternatives. One is the forward rate agreement. Language of the question is very clearly providing to us. It is expected that the firm shall borrow this amount for the entire period of the slack season, that is 6 months, in about 3 months. So we are going to have the borrowing of the funds for 6 months after 3 months. Understand it carefully. The question is providing the information that we are standing over here at point 0, and after 3 months we are going to borrow for 6 months. Like that information is given to us. The information about the spot rate which is given to us is of absolutely no use. Borrowing rate for 3 months after 3 months is irrelevant. Borrowing rate for 6 months after 3 months is relevant for us. So what rate of interest is relevant for us, that we are required to identify first of all, and of course higher rate of interest would be applicable to us for the purpose of borrowing. Now over here let us read the A part of the question. How forward rate agreement shall be useful if actual interest rate after 3 months turns out to be 4.5% and 6.5%. Dear students, we know that whether the rate of interest is increasing or decreasing, in either of the case we will be having the interest to be paid at the rate of 5.94% only. We will be having the effective cost of 5.94% only. That is what we understand. Please write an answer of the question. First of all, dictating some explanation to you for the question. First point, over here information is provided for a company, comma, which is in need of funds, comma, for 6 months after 3 months. Full stop. We understand that 3 into 9 forward rate agreement FRA is required to be taken into account, comma, in that higher rate of interest 5.94 is important. Now with paragraph, once FRA is entered upon, irrespective of actual interest rate, comma, forward rate would be relevant for borrowing of funds and would be the final cost. So friends, over here two rate of interest have been given. Rate of interest 4.5% and 6.5%. Understand it carefully. Interest payment at prevailing rate of interest. We understand, let's say the amount of the funds required is 50 million. Amount of the funds required is 50 million. So over here it is 50 million into rate of interest is 4.5% into 6 divided by 12. Similarly for 6.5% it is 50 million into 4.5% into 6 divided by 12. So it is 11,25,000 and over here it is 16,25,000. Now we understand it's the adjustment for forward rate agreement. Now you can see that say this rate of interest is lower than 5.94% at which the transaction was entered upon. So adjustment for the FRA, in the first case you are required to make the payment. How much payment is required to be made? 50 million into 5.94 minus 4.5 into 6 divided by 12. This is what you are required to pay. 5.94 minus 4.5, so it is 1.44 into 6 divided by 12 is 3,60,000. This is what you are required to pay. While over here you already have paid more, so you will receive 6.5 minus 5.94, so you will receive 0.56 percentage. So it is 50 million into 6.5 minus 5.94. So to this extent you will receive, and your cost will fall down. Into 0.56% into 1 by 2. So 1,40,000. So this is the reduction of the cost. Okay. Now based on this, you'll make the computation of the net cost. In the first case it is 11,25,000 plus 3,60,000. So it is 14,85,000. In the next case, friends, what will happen? 16,25,000 minus, why? Because over there you already have paid high rate, so you will receive the compensation for the difference. So your net cost is 14,85,000. So in both the cases your cost is 14,85,000. So finally, the effective rate of interest will be calculated as I is equal to PRN upon 100. What is the interest amount? 14,85,000 is the interest amount. 50 million into R is required to be found as balancing figure. N is the time period, that is 6 divided by 12. Now R will be found as balancing figure. It is 14,85,000 divided by 50 million into 12 divided by 6 into 100. So what will happen? 14,85,000 divided by 50 million into 12 divided by 6 into 100. That comes to the rate of interest as 5.94%. So we can see that in either of the case your effective rate of interest is 5.94%. Please write down this table and then finally this effective rate of interest. So for any rate of interest, the final answer is going to be same, wherein we understand that so the effective rate of interest will be 5.94% only. Please write down a note. Always rate of interest will be same for both or any other situation given. Full stop. Now friends, basically we are going to, that is we are doing this question so as to understand a new concept that we have, and that is given a name as a futures contract. See, we know that say there is a difference between the forward contract and futures contract. What kind of difference we have? We have a kind of difference like this. As far as a forward contract is concerned, it is informal in nature. Forward contract is customized. Forward contract is entered upon between two parties directly and it is not through any exchange. While the futures contract is exchange traded. Futures contract is for a specific lot size. Futures contract have predetermined the expiry date, that is initial margin, maintenance margin, and all those things that we have. So this time the question says that, say you are entering into the interest rate futures for the purpose of entering into the, that is for the purpose of hedging. So when you enter into the futures contract, then in that case, that is interest rate futures, then in that case we are having certain different types of the contracts. One of the type which is provided over here is like this. You have been provided with the information that 3 months futures contract maturing in a period of 3 months is quoted at 94.15. So basically what happens, let's say we have been provided with the information like this, that say the treasury bill, understand that, so as far as the treasury bill is concerned, for that, so the quotation is given to us as 94.15. 94.15 means the rate of interest is 5.85%. So directly over here, so the rate of interest of 5.85% may not be given. You will be provided with the quotation of the treasury bill. So for the purpose of hedging, you do not have to enter into the transaction for a specific rate of interest as what we do in normal forward rate agreement. Instead of that, so you are required to enter into the transaction for the treasury bill to be sold or to be purchased. So over here the entire point of view is different. What happens at, say today you will enter into the transaction for sale of treasury bill or purchase of treasury bill for the purpose of hedging. Now how do we determine, say, whether to sell or whether to buy? In order to decide that, first of all we have to understand the quotation. Suppose I am taking some simple values first of all. At this point of time, the 3 months rate of interest, 3 months, so the treasury bill quotation is 9090. What does it mean? So this is the quotation. What does it mean? It means that the rate of interest is 10%. Suppose the quotation is 95. Then in that case the rate of interest is 5%. Quotation is 85. Then the rate of interest is 15%. This is what says simply that we understand. Okay. Now you have to see that in which transaction you have to enter upon. You have to enter into a transaction for borrowing of the funds. Okay. Second, you have to determine, say you have a threat, you have fear of what? You have a fear that rate of interest may increase. That is the threat that you have. So what do you want from the futures contract? So what do you want from the futures contract? You want the futures contract to generate the profit if at all the rate of interest is increasing. The company desires to make a profit, if rate of interest increases. Okay. Suppose for the time being, let us assume that the futures quotation is 9090. Now, if at all the rate of interest increases, let us say that the rate of interest, which is 10% right now, okay, increases to, let us say, 15%. Then what will happen? We understand that if at all the rate of interest increases, then in that case the price of the treasury bill will fall down to 85. For the purpose of making profit in the futures, what I should do, say I should sell futures at the rate of 90 and I should buy futures at the rate of 85. Then in that case I will be able to make profit of 5%. We understand that, say, if at all the rate of interest increases, let us say from 10% to 15%, then what will happen? I have to borrow at the rate of 15% from the spot market. However, if at all I already have sold futures, then in that case in the futures I will be gaining 5% and ultimately cost of borrowing of the funds will be 10%. I am repeating my explanation for understanding. Do not write anything. The very first thing that you need to understand that how quotations are provided. How quotations are provided. The quotations are provided like this. Treasury bill futures. It is provided as 90, 95, 85, 80, like that. What does it mean? It means that the rate of interest is 10%, 5%, 15%, 20%. This is the way the quotation is provided. Okay. For the purpose of hedging, hedging of what? Borrowing of my funds. For the purpose of hedging, company can buy or sell treasury bill in futures. Can't I do the transaction for the rate of interest? No, you cannot do the transaction for the rate of interest. However, we understand that indirectly the treasury bill futures prices influence with the change in the rate of interest. So instead of doing the transaction directly for the interest, you are doing for the transaction for the treasury bill which is influenced with the rate of interest only. So ultimately you will be able to do the transaction of the hedging as you want. However, the procedure for doing transaction would be slightly different. Okay. So for the purpose of hedging, the company can buy or sell treasury bill in futures. In which transaction comma I should enter upon for hedging. That is what the company is considering, that in which transaction I should enter upon. Then we'll tell the company that hold, you answer a few questions that I am asking to you. First, what is your transaction? Question mark. The answer is, the company replies that I want to borrow funds. Okay. My second question to the company. What kind of fear, what kind of threat that you have? The threat that I have is rate of interest is increasing. Okay. So what do you want from the futures? I want futures to compensate me in case of rate of interest increases. Compensate me if rate of interest increases. This is what I want from the futures. Okay. Now we understand that today, let us say that the 3 months futures is available at the rate of 90. Now if at all the rate of interest increases, then what will happen? So this 90 will fall down to, let us say, 85 or any other. So what happens at Comparing these two, we can definitely understand for the purpose of making gain, I should sell at a higher value and I should buy at a lower value. So today what you should do, so today you should enter into the transaction for sale index futures. That is sale interest futures, I'm sorry. That is what you should do. So if at all the rate of interest increases, then in spot you have to buy, that is you have to borrow at a higher rate. However, you will be able to get the compensation of the gain that you will be able to make over here in that is treasury bill futures. Okay, treasury bill futures, so which is nothing else but it is the interest futures only. If at all the things are not as what you had thought, you thought that the rate of interest will go up, but instead of going up, let us say that it has gone down. Suppose it has gone down to 8%, so this will become 92. So in that case, you will be having say a loss of 2% over here. So in case of the interest rate futures transaction, you will be incurring a loss, but over there in the spot you have to borrow at the lower rate of interest, and overall your cost is going to be once again 10%. This is what we understand. First of all, I am dictating a note to you. First of all, I am going to dictate you a note for this, and then we are going to understand a small formula and then answer. Write down heading interest rate futures. In that, write down first point. This is a transaction for hedging borrowing / investment. Second point, this transaction has underlying rate of interest. Full stop. There will be a lot size and a fixed time period for which transaction can be entered upon. Third point, suppose rate of interest is 10%, comma, in that case quotation of interest rate futures is 19. In bracket write down 100 minus 10. Full stop. It means for different rate of interest quotation of interest rate futures will be as under. Rate of interest, interest rate futures 5, 10, 15, 20, 95, 90, 85, 80. Fourth, this time transaction can be entered upon for selling treasury bill at the rate of 95, 90, 85 or 80 or any other price as prevailing. Full stop. Friends, over here selling slash buying. It depends upon your transaction of borrowing or investment in spot market. Spot market means after 3 months what you are going to do. So friends, till this point of time I have dictated to you only a general points. Okay. Now I am dictating to you specific points. Suppose you are going to borrow funds, comma, then you have a fear that rate of interest will increase. Full stop. You want interest rate futures to compensate you for higher interest to be paid in spot market. Full stop. Interest rate futures should give you profit to compensate higher interest to be paid in spot market. Full stop. We understand that price of T-bill will fall if rate of interest increases. Full stop. So you should sell interest futures for hedging your transaction of borrowing. So if actual rate of interest increases in spot, you have to pay more interest but in futures you will gain. Full stop. This point is very important. Which paragraph write down? Today, after 3 months, sale at 90, buy at 85, so that is a profit of 5. This 90 is indicating 100 minus 10. The rate of interest increases to 15, so 100 minus 15. So in spot you have to pay 15, but over here you make a profit of 5. I request all of you to go through the note till the 5th point properly, and then we are proceeding further. Hopefully all of you have gone through the reading so far that I have dictated to you. Now explaining further to you a new point. See what happens at over here. We have to borrow an amount of euro 50 million. So 1 million is equal to 10 lakhs. So 50 million is equal to 500 lakhs. Okay. This is the amount that say you want to borrow. We have been provided with the lot size that is 50,000. So we understand that say if at all we enter into one contract, it is like the transaction is entered upon for 50,000. However, we understand that say this is the number of contracts to be entered upon for the amount of 500 lakhs. So it is 500 lakhs divided by 50,000, so that comes to 1,000 number of contracts. This is what we understand logically. However, there is an additional point apart from this normal point. What is that? Dear students, we understand that we want to borrow for a time period of 6 months. However, the futures contract is available only for 3 months. 3 months euro 50,000 futures contract maturing in a period of 3 months is quoted at 94.15. So 3 months euro 50,000 futures contract. So you can see that say the futures contract is available only for 3 months, and it is not available for it is not available for 6 months. We want to borrow for a time period of 6 months. However, we can see that over here only 3 months futures contract is available. That is the reason, say instead of entering into 1000 number of contracts, we have to enter into double number of contracts, say to give the effect of the time period. You cannot do the transaction only for 1000 number of contracts, because what will happen if at all the rate of interest increases? Then in that case, in spot, you are required to make the payment of interest for 6 months. While over here, say you will be able to get the compensation only for the 3 months interest. So you are required to enter into the number of contracts as 2000. So we can say something like this. Understand it carefully. Number of contracts to be entered upon is amount of borrowing divided by lot size. So that will give us the number of contracts in a usual, in a same situation, that is if at all the futures contract is also available for 6 months time period, but over here it is available only for 3 months time period. So we have to add one more thing over here, is time period of borrowing divided by time period of futures contract. That is the way we are required to make this adjustment, and we have to enter into the number of contracts to be entered upon. Dear students, I have dictated to you only for the borrowing the entire detailed explanation. Of course, you can understand that say in case of the investment, the reverse transaction is required to be entered upon. Please write down the formula. So now we are doing answer of the question. Okay. Write down answer. Answer for the second part of the question. How 3 months futures contract, this is what they are providing. 3 months futures contract shall be useful for the company if the interest rate turns out to be as mentioned in part A. So after 3 months, the rate of interest is just in the market. Means the quotation for the futures would be 100 minus 4.5, that is 95.5, and 100 minus 6.5, that is 93.5. In both the cases, say what will happen, that's you are required to answer. So how the futures contract shall be useful, that is a question. So we can say something like this. Working note number 1. Write down answer along with me. Number of futures contract to be sold. Now, why to sell? For that, say we have understood logically that say as we are going to borrow, and if at all there is an increase in the rate of interest, I have to pay high rate of interest in the spot market, and in that case the futures quotation would have gone down, and I would be able to make the profit of the difference between the originally price at which I have sold the contract and the spot price at which we are going to buy it. And that is the way I will be able to say compensate the loss of the high interest rate. Please write down answer. amount of borrowing divided by lot size into time period of borrowing divided by time period of futures contract. So what is the amount of borrowing? Amount of borrowing is 50 million 500 lakhs divided by 50,000 into 6 divided by 12. So it is 1000 into 2, that is 2000 contracts. So this is the number of contracts to be entered upon. With paragraph write down, calculation of effective cost of borrowing comma for both situations. There are two situations provided to us. One is the rate of interest 4.5 and another is 6.5. So this is 4.5 and this is 6.5. These are the two rate of interest provided to us. We understand that first of all we are required to show payment of interest. That is simple. The rate at which you are required to pay the interest in the spot market. It is 500 lakhs into 4.5 percentage into 6 divided by 12. Why 6 divided by 12? Because you want to borrow funds for 6 months. Similarly over there 500 lakhs into 6.5 percentage into 6 divided by 12. $11,25,000 in the first case, $16,25,000 in the next case. That is the way we will have the payment of interest. Now we will have profit or loss in interest rate futures. Now friends, we understand that originally we have sold the number of futures contract 2000 and for that the quotation is 94.15. So what will happen? Understand it carefully. 94.15 is the sale price, okay? Minus, in this case, what is the purchase price? 100 minus 4.5. Whatever the answer, that is the purchase price, that is 95.5. So 94.15 minus 95.5. So 1.35% is your loss. Multiplying with, we understand that say over here, number of contracts are 20,000, so 2,000 into 50,000 is the lot size. This is what we understand. So over here 2000 into 50,000, that is 94.15 minus 95.5 into 1000 lakhs into 3 divided by 12, because this futures contract is for 3 months. So over here it comes to 3,37,500. That is the amount of the loss that we have. This would be in the percentage term, okay? So this will be in the percentage term. So what will happen over here, friends? 94.15 minus 95.5. So it is 1.35 percentage. So it is negative 0.0135 into 1000 lakhs into 0.25. Into 1000 lakhs into 0.25. That comes to loss of 337,500. So over here, overall, you will be having 11,25,000 that you have paid in the spot market, and further there is a loss of 337,500. So your overall cost is going to be 14,62,500 in the first case. Similarly, in the next case, you will make the calculation. Wherein we understand that, say, what is your sale price? It is 94.15. What is your purchase price? It is 100 minus 6.5. So difference of that is the sale, that is profit or loss that you have, divided by 100, because this answer is going to be in the percentage term. Multiplying with 2000 is the number of contracts. Multiplying with 50,000, that is the lot size. This is what we have, into 3 divided by 12. So over here 94.15 minus 93.5. So it is 0.65 percentage into 2000 into 50,000 into 3 divided by 12. So you make a profit of 1,62,500. So 16,25,000 is outflow, 162,500 is inflow with the interest rate futures settlement. So your net cost is going to be 14,62,500. Okay. Now we understand that, so the effective interest. Rate will be calculated like this: I is equal to PRN upon 100. This is the way it is calculated. So it is I is 14,62,500. This is your cost. What is the amount? It is 50 million. What is the rate that is required to be found by us? What is the time period? It is 3 divided by 12. Okay. So R is equal to 14,62,500 upon 50 million or 500 lakhs into 12 divided by 3 into 100. 14,62,500 into 12 into 100 upon 500 lakhs divided by 3. 14,62,500 into 12 into 100 upon 50 million. I'm sorry friends, over here it is 6 months. Sorry. So 14,62,500 into 12 into 100 upon 500 lakhs, and that comes to 5.85 percentage. And this rate of interest is exactly the same as what originally it was quoted. And always the answer is going to be like this only. This is a way, so we can cross verify the answer. So this is the way we will have the cost as 5.85 percentage. Please take down this. We can understand that say when the rate of interest increases, then in that case you have to pay high rate of interest in the spot market. However, the interest futures will give you the compensation and your cost reduces. If at all the spot rate decreases, then in that case in spot you have to pay low rate of interest. However, in that case you will incur a loss in the interest rate futures. Summary of the answer. We understand that over here, first of all, basically after 3 months you want to borrow for 6 months. Two rate of interest have been given to us, 4.5 and 6.5. For both the interest rates, that is the actual rate of interest is given that. If at all the forward rate agreement is entered upon, then in that case what will be your effective cost is required to be calculated. We understand that say whatever the forward rate of agreement which has been entered upon 5.94 itself is a rate that will be applicable over here. This. The remaining information I provided just to misguide us, that is of no use to us. 3 into 9 FRA is important. Yet I think that the first part of the question is not so important. Second part of the question is very important, which is new for us. The first thing that we have to understand this quotation. This quotation is provided to us as a rate of interest deducted from 100 value. This is the T-bill futures quotation. We cannot enter into the transaction for borrowing or lending at the specific rate of interest. That is over here 5.85. You cannot do that. However, you can do the same transaction some indirectly. Wherein what you do the transaction in the treasury bill. It is important for you to have understanding that how the price of the treasury bill will fluctuate with the fluctuation in the rate of interest. That is what says something which is important over here. Since you are going to borrow, you have a fear of the rate of interest to go up. If it is going up, then in that case you have to pay high rate of interest in the spot. So to cover up that loss, what you will do in futures, say you enter into the transaction for sale futures. So what will happen if after the rate of interest is actually going up, then in that case say the futures value will fall down, treasury bill value will fall down. So if you already have entered into the transaction for sale earlier, then difference of that is the amount of the profit that you will be able to make. And for that, say I have dictated to you a detailed note regarding the quotation, regarding the transaction in which you will enter upon. One more important point that say we have seen is that we want to borrow for 6 months. However, so the futures contract is available only for 3 months. The question says that say the 3 months futures contract. So this what is important. That is the reason so the number of contracts which are required to be entered upon will be adjusted with this. or we can say that say every time we can mention this in the formula. If at all you are having say exactly the same, it will be cancelled against one another. Fine. Then this is the number of contracts in which you have entered upon for the purpose of sale. Why? Because you are going to borrow. Now actual rate of interest is 4.5. Means the future quotations will be 95.5. You have entered into the transaction for sale at 94.15. So difference of that is the profit or loss that you have. In both the cases we have calculated. Further importantly friends, so this is the per annum rate of interest. So we are required to make the computation for the 3 months. Why? Because the 3 months futures contract is there. This is what we understand. Lastly, we will find that in both the cases the effective cost is same. If at all the rate of interest is going up, then in that case in spot you have to pay high interest, but you get a compensation over here, and vice versa in this case. That is the way the effective cost is 5.85%, which was the initial quotation of the interest rate futures.